The next market crash will not begin with panic. It will begin with silence. No breaking news, no sudden collapse, no obvious trigger. While markets sit near their highs, the system is already losing the one thing it cannot survive without: flexibility. Debt has already repriced. Liquidity has already thinned. Policy has already spent most of its ammunition. What remains is time. And time is running out faster than most investors realize. This is not a prediction, it is a sequence. And once that sequence reaches its final stage, markets will not ask whether you are ready. The market looks calm because it is still pricing yesterday's world, not tomorrow's reality. Indexes hover near record levels, volatility remains compressed, and headlines continue to repeat the same comforting narrative: resilience, soft landings, controlled inflation, and a return to normal. From the outside, the system appears stable, almost boring. Capital continues to flow into equities, credit spreads remain tight, and investors behave as if the last cycle never truly ended. This is not strength, this is inertia. Markets do not move based on what is happening now. They move based on what already happened and what they believe will continue to happen. At this stage of the cycle, asset prices are still reflecting the afterglow of extraordinary liquidity injected years ago. Cheap capital shaped balance sheets, inflated valuations, and trained investors to expect that any slowdown would be met with rescue. That conditioning has not disappeared. It is deeply embedded in behavior, models, and risk assumptions. Corporate earnings, on the surface, still appear healthy. Many firms locked in long-term financing when money was cheap, extending maturities and lowering near-term pressure. Stock buybacks continue, supported by cash accumulated during the stimulus era. Employment data remains relatively strong, reinforcing the belief that the real economy can absorb higher rates indefinitely. This combination creates a dangerous illusion: the idea that the system has adapted, that it has somehow evolved beyond cycles. But adaptation is not immunity. What looks like resilience is often just delay. Financial markets are currently anchored to backward-looking data. Earnings reports reflect contracts signed months or years ago. Labor statistics lag real demand. Inflation prints capture pricing power that was negotiated under very different conditions. None of these indicators tell you where stress is forming. They only confirm what already worked. By the time they turn, the repricing is never gentle. The most deceptive signal is the market itself. When prices remain elevated, investors assume risk has diminished. In reality, prolonged stability often means leverage has quietly increased. Volatility suppression encourages more exposure, more derivatives, more duration risk. Portfolios become fragile, not because investors are reckless, but because calm rewards concentration. Stability breeds complacency, and complacency breeds structural weakness. Look beneath the surface and the picture changes. Equity valuations remain historically stretched relative to long-term earnings growth. Credit markets price default risk as if refinancing will remain painless. Real estate values still assume abundant liquidity, even as transaction volumes dry up. This divergence between price and underlying activity is not sustainable. It is a classic late-cycle signature. Global capital flows reinforce the illusion. International investors, facing uncertainty at home, continue to park money in perceived safe markets. This supports asset prices even as domestic fundamentals weaken. Currency dynamics mask stress by attracting yield-seeking capital into systems already strained. What appears as confidence is often just relative fear elsewhere. Central banks play an unintentional role in sustaining this false calm. After years of intervention, markets have learned to interpret any pause or moderation as a signal of future easing. Even when policy remains restrictive, the absence of further tightening is framed as relief. This creates a perverse feedback loop where bad news becomes good news, and good news justifies higher risk. The result is a market that refuses to price downside honestly. History shows that the most dangerous moments are not when fear dominates, but when conviction does. When investors agree that a new paradigm has arrived, that cycles have been tamed, that risk has been engineered away, vulnerability peaks. The system becomes optimized for continuation, not resilience. Any deviation from the expected path then carries disproportionate consequences. The illusion of strength is reinforced by selective memory. Recent crises are framed as anomalies, quickly resolved by policy action. Structural imbalances are rebranded as temporary distortions. Debt accumulation is justified as manageable because it has been manageable before. What is forgotten is that systems do not break when debt exists, but when the cost of carrying it changes. Right now, markets are still anchored to a world where capital was abundant, refinancing was easy, and growth could be pulled forward without consequence. That world no longer exists, but its shadow still shapes prices. This gap between perception and reality is the breeding ground for future instability. Nothing is visibly broken yet. That is precisely the problem. When cracks are obvious, adjustments have already begun. When everything looks fine, risk is at its most asymmetric. The market does not need a shock to collapse. It only needs the slow realization that the assumptions holding prices up are no longer valid. This chapter is not about predicting an immediate fall. It is about understanding why the current calm is misleading. The system is not strong, it is simply late. Late in repricing, late in recognizing cost, late in accepting that the environment has changed. And late systems do not fail loudly at first. They fail quietly, then suddenly. What investors are seeing today is not stability. It is the final stage of belief. Economic damage never arrives on schedule. It moves through the system with delay, distortion, and disguise. By the time it becomes visible in headlines, markets have already absorbed the shock and repriced violently. What investors consistently misunderstand is not the direction of policy, but its timing. Monetary tightening does not break economies immediately. It works its way through balance sheets, contracts, labor markets, and credit structures over long and uneven intervals. This delay is not a flaw, it is the mechanism. Interest rate changes affect different parts of the economy at different speeds. Financial assets react first, then credit conditions, then corporate behavior, and only much later employment and consumption. This sequence creates a false sense of security early in the cycle. When rates rise, markets expect immediate consequences. When those consequences fail to appear, confidence grows that the system can absorb higher costs indefinitely. That conclusion is almost always wrong. The current environment is defined by this lag. Policy tightening that began years ago is still working its way through the real economy. Much of today's activity is supported by decisions made under entirely different financial conditions. Businesses are operating on credit lines negotiated when money was cheap. Households are spending based on mortgages locked in at historically low rates. Governments are funding deficits with debt issued before yields repriced upward. None of this reflects today's cost of capital. This is why headline data continues to look resilient. Employment remains elevated not because demand is accelerating, but because firms are slow to adjust labor. Hiring freezes come long before layoffs, and layoffs come long after margins compress. Companies initially respond to higher costs by cutting discretionary spending, delaying investment, and drawing down cash reserves. Labor is the last lever pulled, not the first. Consumer behavior follows a similar pattern. Spending does not fall when rates rise. It falls when savings are depleted and credit becomes inaccessible. Households initially maintain consumption by using buffers accumulated during previous expansionary periods. Credit cards, personal loans, and deferred payments bridge the gap. This creates the illusion of demand stability, even as purchasing power erodes. Inflation statistics further distort perception. Price indices reflect transactions agreed upon months earlier. Rent data lags housing markets significantly. Wage growth captures contracts negotiated in a different economic context. These indicators remain elevated or stable long after underlying momentum is shifted. Policymakers and investors alike mistake persistence for strength. The most critical delay operates in the corporate debt market. A large portion of outstanding debt does not reprice immediately. Fixed-rate obligations with long maturities insulate firms from short-term stress. On paper, balance sheets look manageable. Interest coverage ratios appear stable, defaults remain low. This reinforces the belief that higher rates are tolerable. But debt does not disappear, it matures. As refinancing cycles approach, yesterday's assumptions collide with today's reality. Debt issued at near-zero rates must be rolled over at multiples of its original cost. This transition does not happen overnight. It unfolds gradually, firm by firm, sector by sector. Early on, only the weakest entities feel pressure. Later, stress migrates upstream. This is why early cycle tightening rarely causes immediate recession. The economy continues to function on legacy terms. Capital allocation decisions lag policy changes. Investment plans proceed until financing constraints become binding. Only when old credit structures expire does the true cost of money assert itself. Global dynamics amplify this delay. In an interconnected system, capital flows smooth local stress. Weakness in one region is offset by inflows from another. Yield differentials attract money into markets that appear stable, even if that stability is artificial. Currency strength masks domestic fragility. Trade balances adjust slowly. These cross-border effects stretch the timeline further. Governments also contribute to the lag. Fiscal spending cushions private sector weakness. Deficits expand to maintain growth, delaying contraction. Public borrowing absorbs shock that would otherwise force rapid adjustment. This postponement is politically convenient, but economically destabilizing. It shifts pressure forward in time rather than resolving it. Financial markets misinterpret this delay as evidence of success. When recession fails to arrive on cue, narratives shift. Analysts declare soft landings. Commentators argue that structural improvements have neutralized cycles. Models are recalibrated to assume higher neutral rates and perpetual resilience. Risk premiums compress further. Leverage quietly increases. This stage is the most dangerous. The economy is not healing. It is accumulating future strain. Every additional month of apparent stability encourages behavior that becomes unsustainable under new conditions. Companies extend projects that require cheap financing. Consumers commit to payments that assume income stability. Governments expand obligations based on optimistic revenue projections. These commitments harden just as flexibility disappears. When the lag finally ends, adjustment is abrupt. Credit availability contracts, margins compress rapidly. Employment reverses faster than it rose. Demand weakens simultaneously across sectors that previously appeared insulated. What felt like a gradual process reveals itself as a step function. The key insight is simple but uncomfortable. Monetary policy always works, just not on the timeline people expect. By the time its effects are undeniable, there's no opportunity to react calmly. The market does not wait for confirmation, it moves ahead of it. This delayed transmission is not a mystery. It is documented across decades of cycles. Yet each time, investors convince themselves that this time is different. That belief persists right up until the moment it becomes irrelevant. This is only the first half of the mechanism. The lag explains why the system still appears stable. The next phase explains why that stability will not last. The second phase of the delay is where the illusion begins to fracture, but not in a dramatic way. It breaks through pressure, not panic. By the time the lagged effects of tightening reach this stage, the system is already committed to decisions made under outdated assumptions. This is where slow damage becomes irreversible. The first visible stress does not appear in equity markets. It appears in credit. Lending standards tighten quietly. Banks do not announce fear, they adjust terms. Loan covenants become stricter. Margins widen. Collateral requirements rise. Access to capital narrows not because money is unavailable, but because it has become selective. This distinction matters. Markets can survive scarcity. They struggle with discrimination. Small and mid-sized businesses feel this shift before large corporations. They lack diversified funding channels and rely heavily on bank credit. When terms tighten, expansion plans are paused, hiring slows, and capital expenditure is deferred. None of this registers immediately in headline data. Output remains stable. Employment holds. But momentum weakens beneath the surface. At the same time, large firms begin to face a different problem. Their scale protected them early in the cycle. Long-dated debt insulated cash flow. Access to bond markets remained open. But scale also creates rigidity. High fixed costs and complex capital structures reduce flexibility. When refinancing windows approach, these firms cannot adjust quietly. Their needs are too large. This is where the refinancing wall becomes systemic rather than isolated. Entire cohorts of corporate debt mature within narrow timeframes. When this happens under restrictive monetary conditions, competition for capital intensifies. Borrowers are no longer negotiating from a position of strength. Lenders dictate terms. Costs rise sharply, not gradually. Profitability then becomes a mathematical problem, not a strategic one. Even well-managed companies find that incremental revenue growth no longer offsets higher financing costs. Margins compress from both sides. Input prices remain elevated due to structural inflation, while pricing power weakens as demand softens. Earnings disappoint not because sales collapse, but because costs reassert dominance. Equity markets initially misread this phase. Investors focus on revenue resilience and ignore balance sheet stress. Stocks remain elevated as long as earnings declines appear manageable. Valuations stay stretched because discount rates are assumed to normalize. The belief that rate cuts are inevitable becomes a pillar of optimism. This belief is rarely tested until it fails. Households enter their own delayed adjustment at this point. Fixed rate protections begin to expire. Variable rate debt resets. Consumer credit becomes more expensive and less available. Monthly payments rise, even as income growth slows. Savings buffers shrink. Spending habits change subtly at first. Discretionary purchases are postponed. Big ticket items are delayed. Services feel pressure before goods. This shift feeds back into corporate performance with additional delay. Lower consumer demand does not hit balance sheets immediately. Inventory absorbs shock. Promotions smooth sales. Companies try to preserve margins by cutting costs elsewhere, but cost cutting has limits. Once reached, revenue weakness flows directly into earnings. Governments, facing slowing private activity, often respond with additional fiscal measures. Spending increases, deficits widen. This temporarily supports growth but exacerbates the underlying imbalance. Public borrowing competes with private refinancing needs. Yield curves remain under pressure. The cost of capital stays elevated longer than markets expect. Global synchronization intensifies the problem. When multiple economies enter this phase simultaneously, diversification fails. Capital cannot rotate easily to unaffected regions because few remain. Trade slows. Currency volatility rises. External demand weakens just as domestic demand softens. The global system amplifies local stress instead of absorbing it. Financial institutions become increasingly defensive. Risk models adjust. Capital buffers are reinforced. Exposure to cyclical sectors is reduced. This is not a crisis response, it is precaution. But precaution has consequences. Reduced lending constrains growth. Market liquidity thins. Price discovery becomes fragile. This is the stage where stability still exists, but fragility dominates. Nothing appears broken, yet everything depends on continuation. The system requires that refinancing remains smooth, that demand does not fall sharply, that policy pivots arrive on time. These conditions are not guaranteed, they are assumed. The critical mistake at this point is extrapolation. Investors project recent resilience forward. Policymakers rely on backward-looking indicators. Corporations assume conditions will ease before pressure peaks. Households hope adjustment will be temporary. Everyone expects relief just before strain becomes unbearable. History suggests the opposite. Relief rarely arrives before damage is done. Policy operates on its own lag. Markets move faster than institutions. By the time easing begins, balance sheets have already adjusted in ways that cannot be reversed. This is where the delayed economy reveals its true nature. What appeared as a soft landing is exposed as deferred impact. Growth does not gently slow. It steps down. Confidence does not gradually erode. It shifts abruptly. The transition from stability to instability happens not when conditions worsen visibly, but when expectations break. This completes the mechanism of delay. The system has now absorbed the full weight of past tightening. The remaining question is not whether stress exists, but where it concentrates. The next chapter answers that by examining debt, leverage, and the point where mathematics overrides narrative. Debt is not dangerous by itself. It becomes dangerous when its price changes faster than income can adjust. This is the core misunderstanding at the heart of every modern crisis. Economies do not collapse because they borrow. They collapse because the assumptions under which that borrowing occurred expire simultaneously. What follows is not a panic. It is arithmetic. For years, debt accumulated under the premise that money would remain cheap, abundant, and rollable. This premise shaped behavior across every layer of the system. Corporations optimize capital structures around leverage rather than resilience. Governments normalize deficit spending as a permanent tool rather than an emergency measure. Households treated low rates as a fixed feature of life, not a temporary condition. None of these decisions were irrational at the time. They were consistent with the environment that existed. That environment no longer exists. The global debt load has reached levels that only function under narrow financial conditions. Public and private obligations combined dwarf productive growth. Servicing this debt requires either continuous refinancing at manageable rates or sustained real income expansion. When neither is available, stress migrates rapidly. Not through defaults at first, but through compression. Corporate balance sheets illustrate this clearly. Many firms appear solvent because their interest expenses are still manageable. What is often overlooked is that this manageability is backward-looking. Interest coverage ratios reflect yesterday's coupons, not tomorrow's obligations. As debt matures and rolls forward, costs reset upward. Even modest increases in average borrowing rates translate into significant cash flow pressure when applied to large notional amounts. This is the debt trap. Once leverage crosses a certain threshold, small changes in rates produce outsized effects. A single percentage point increase in borrowing cost can erase years of margin expansion. Capital that once funded growth is redirected towards servicing past decisions. Investment slows, not because opportunity disappears, but because obligation dominates. Governments face a similar dynamic, amplified by scale. Sovereign debt issuance expanded dramatically during periods of crisis response and economic support. Initially, low yields made this expansion appear sustainable. Debt-to-output ratios rose, but servicing costs remained contained. This illusion holds only as long as yields remain suppressed. When rates rise, interest expense accelerates far faster than tax revenue. Fiscal space narrows even as social and political demands increase. At that point, governments face a constrained set of choices. They can cut spending, which risks recession. They can raise taxes, which pressures growth. Or they can borrow more at higher cost, compounding the problem. None of these options resolve the underlying imbalance. They only redistribute pain across time and sectors. Households complete the picture. Consumer debt expanded alongside asset prices, reinforcing the belief that balance sheets were strong. Rising home values and equity markets masked leverage by inflating net worth, but net worth is not cash flow. When financing costs rise and asset prices stall, households lose flexibility. Debt service consumes a larger share of income, just as wage growth slows. Consumption becomes fragile. This fragility does not present as immediate collapse. It presents as stagnation. Spending plateaus. Savings rates fall. Credit reliance increases. The system continues to function, but at lower efficiency. Growth becomes dependent on continued borrowing rather than productivity. This is unsustainable over any meaningful horizon. The danger intensifies because debt maturity profiles are clustered. Obligations do not reprice evenly over time. They concentrate. When large volumes of debt mature within similar windows, refinancing pressure spikes. This creates competition for capital precisely when lenders are most cautious. Terms deteriorate rapidly. Covenants tighten. Spreads widen. The cost of failure rises. Markets often underestimate this risk because defaults lag stress. Insolvency is a late-stage outcome. Long before defaults increase, economic behavior changes. Companies cut investment. Governments prioritize debt service over growth initiatives. Households reduce discretionary spending. These adjustments suppress growth, which in turn worsens debt ratios. Feedback loops form. At this stage, narratives begin to fracture. Analysts debate whether the problem is growth or inflation, fiscal policy or monetary restraint. These debates miss the point. The issue is not policy preference. It is structural leverage interacting with higher capital costs. Once that interaction begins, outcomes narrow. International dynamics offer no escape. Global debt markets are interconnected. Stress in one region transmits through funding channels, currency markets, and trade flows. When multiple major economies face refinancing pressures simultaneously, diversification fails. Capital becomes defensive rather than opportunistic. Liquidity fragments. Emerging markets feel this acutely, but developed markets are not immune. Reserve currency status delays adjustment, but does not prevent it. Borrowing in one's own currency reduces default risk, but increases inflationary risk. The constraint shifts form, not substance. Real purchasing power erodes instead of nominal solvency. This is where the illusion of control breaks down. Central banks can influence short-term rates, but they cannot rewrite balance sheets without consequence. Lowering rates too early risks reigniting inflation. Holding them high prolongs debt stress. Either path carries cost. Policy becomes reactive rather than proactive. The debt trap does not require a trigger. It is self-activating once conditions align. Higher rates, slowing growth, and large refinancing needs are sufficient. From that point, the system moves toward deleveraging, whether it intends to or not. The only variable is how orderly the process will be. This is the first half of the debt story. It explains why leverage that once amplified growth now suppresses it. The second half explains why this suppression does not remain contained, and how it ultimately forces markets to reprice risk abruptly rather than gradually. The second half of the debt story begins when suppression turns into compulsion. At this stage, leverage no longer merely constrains growth, it dictates behavior. Economic actors stop optimizing for expansion and begin optimizing for survival. This shift is subtle at first, but it changes the trajectory of the entire system. Corporations facing refinancing pressure adjust priorities immediately. Capital expenditure becomes discretionary. Research budgets shrink. Expansion plans are shelved. Shareholder returns are reconsidered. Management language changes from growth narratives to efficiency narratives. Earnings calls emphasize discipline, cost control, and balance sheet strength. These are not signs of health. They are signs of defense. What makes this phase dangerous is that it is internally rational but collectively destructive. Each firm protecting itself reduces aggregate demand. Each delay in investment weakens future productivity. Each cost cut preserves margins temporarily while eroding long-term capacity. The economy does not contract violently. It contracts mechanically. Financial markets struggle to price this transition because it lacks drama. There is no single collapse point. Instead, expectations adjust unevenly. Some sectors reprice early, others lag. Correlations increase as diversification benefits erode. Investors rotate defensively, but capital does not disappear. It concentrates. Valuations and perceived safe assets inflate further, increasing systemic imbalance. Credit markets react faster than equity markets in this phase. Spreads widen before defaults rise. Yield curves reflect rising term premiums. Risk-free rates remain elevated because sovereign borrowing needs stay high. The cost of capital refuses to fall even as growth slows. This frustrates market participants who expect policy relief to arrive automatically. It does not. Households experience compulsion through constraint. When debt service rises relative to income, choice narrows. Consumption decisions become reactive. Spending prioritizes necessity over preference. Services weaken before goods. Housing activity slows sharply as affordability collapses. Labor markets respond last, but when they do, the adjustment is abrupt. Governments face the most severe version of compulsion. As debt servicing costs absorb a larger share of budgets, flexibility vanishes. Fiscal multipliers weaken. Stimulus becomes less effective because it is offset by higher financing costs. Political pressure intensifies as voters feel the squeeze. Policy debates become polarized. Decision-making slows precisely when speed matters most. At this point, the system becomes vulnerable to secondary shocks. These shocks do not need to be large. They only need to occur when buffers are thin. A commodity price spike, a geopolitical disruption, a banking stress event, or a sudden loss of confidence in a major borrower can accelerate adjustment dramatically. The system lacks redundancy. Markets often misinterpret these events as causes rather than catalysts. The underlying cause remains leverage interacting with cost. The shock simply reveals fragility that already existed. This distinction matters because removing the catalyst does not restore stability. Once confidence breaks, behavior does not revert easily. Liquidity plays a central role here. In highly leveraged systems, liquidity is assumed to be continuous. When this assumption fails, prices gap. Buyers retreat not because assets are unattractive, but because balance sheets are constrained. Selling becomes mechanical. Risk limits are hit. Margin requirements rise. The market feeds on itself. This is the moment where repricing accelerates. Discount rates adjust upward simultaneously across asset classes. Future cash flows are revalued under more conservative assumptions. Valuations compress, not gradually, but in steps. Volatility spikes as participants attempt to recalibrate. Correlations converge toward one. Central banks respond cautiously. They are aware of the debt burden, but constrained by inflation credibility. Cutting rates aggressively risks undermining currency stability and reigniting price pressures. Holding rates steady prolongs stress. Communication becomes ambiguous. Markets oscillate between hope and disappointment. This uncertainty increases volatility further. The debt trap now reveals its final characteristic. It limits policy optionality. Authorities can no longer choose optimal outcomes. They can only choose trade-offs. Any intervention benefits one sector at the expense of another. Any delay increases cumulative damage. Confidence in control erodes. International coordination offers limited relief. Each economy faces similar constraints. Competitive easing risks currency instability. Competitive tightening risks synchronized slowdown. Global institutions lack the mandate to resolve structural leverage. They can provide liquidity, not solvency. As this phase progresses, narratives collapse under their own weight. Soft landing expectations give way to acceptance of adjustment. Analysts revise forecasts downward, ratings agencies reassess risk. Capital preservation replaces return maximization. The psychology of the market shifts decisively. Importantly, this shift does not require catastrophic data. It requires recognition. Once participants collectively acknowledge that leverage is no longer a tailwind but a headwind, behavior changes permanently. Recovery becomes conditional rather than assumed. This is why debt-driven downturns are so difficult to arrest. They are not cyclical in the traditional sense. They are balance sheet events. They resolve through restructuring, deleveraging, or inflationary erosion. All three paths involve pain. None preserve the status quo. The debt trap reaches its conclusion when markets accept that yesterday's growth was borrowed from tomorrow, and tomorrow has arrived with a bill attached. At that point, repricing is no longer a risk. It is an inevitability. This completes the debt chapter. The system is now positioned not for sudden collapse, but for fragility under stress. The next chapter examines what happens when liquidity, the final illusion of safety, begins to disappear quietly from the system. Liquidity never disappears with an announcement. It withdraws quietly, almost politely, leaving prices intact long after the underlying support has gone. This is one of the most misunderstood dynamics in modern markets. Investors are conditioned to watch rates, indexes, and headlines. They rarely watch liquidity itself, because liquidity is not a headline variable. It is a condition, and when it changes, everything else eventually follows. In the early stages of tightening, liquidity appears abundant. Markets continue to trade smoothly. Bid-ask spreads remain tight. Large transactions clear without disruption. This creates the impression that capital is still freely available. In reality, what remains is residual liquidity, not active liquidity. The difference is critical. Residual liquidity is money already committed. Active liquidity is money willing to take new risk. The second disappears long before the first. Banks are the first place where this shift becomes visible, but only to those who know where to look. Balance sheet capacity tightens. Risk-weighted assets become more expensive to hold. Regulatory capital requirements interact with higher rates to reduce risk appetite. None of this produces panic. It produces caution. Lending does not stop. It becomes conditional. This conditionality reshapes the economy quietly. Credit is extended to fewer borrowers on stricter terms for shorter durations. Projects that once cleared internal hurdle rates no longer qualify. Real estate transactions stall not because buyers vanish, but because financing fails to close. Venture funding slows not because ideas deteriorate, but because exit assumptions change. The machine still runs, but with friction. Market liquidity follows the same pattern. Dealers provide less balance sheet support. Inventory is minimized. Market making becomes less aggressive. During calm periods, this reduction is invisible. Prices still move. Charts still look orderly. But the system loses its shock absorbers. When stress arrives, there is nothing to dampen it. This is why liquidity crises always feel sudden. They are not sudden. They are revealed. The withdrawal happens over months. The recognition happens in days. Central bank balance sheets play a central role here. Years of asset purchases condition markets to expect an ever-present buyer of last resort. As balance sheets stop expanding or begin to contract, that expectation becomes invalid. Quantitative tightening does not need to drain massive amounts of capital to matter. It only needs to change behavior. When participants know that liquidity will not automatically be replenished, risk calculus shifts. This behavioral shift is already visible in funding markets. Short-term funding becomes more volatile. Term premiums rise. Collateral quality matters again. Instruments once treated as near money regain their risk characteristics. These changes rarely make headlines, but they alter incentives across the system. Asset managers respond by holding more cash equivalents. This appears prudent on an individual level, but collectively it removes demand from risk assets. Pension funds rebalance. Insurance companies shorten duration. Hedge funds reduce gross exposure. None of these moves cause immediate price declines. They reduce depth. Depth is what allows markets to absorb shocks. Without it, price discovery becomes fragile. Small imbalances produce outsized moves. Volatility spikes not because information changes dramatically, but because there are fewer participants willing to intermediate. The most dangerous aspect of liquidity withdrawal is that it coexists with high valuations. Prices remain elevated because selling pressure has not yet materialized. This creates a false sense of security. Investors believe liquidity is ample because prices are high. In reality, prices are high because liquidity has not yet been tested. When testing begins, the response is asymmetric. Buyers hesitate, sellers rush. This asymmetry defines late cycle markets. Global liquidity compounds the problem. Cross-border flows once provided redundancy. When one market tightened, capital migrated elsewhere. In a synchronized tightening environment, this safety valve fails. Major central banks operate under similar constraints. Currency hedging costs rise. International allocation becomes less attractive. Capital stays home, defensive and cautious. This is particularly important for reserve currency systems. Strong currencies attract capital, but that capital often sits in short-term instruments rather than productive investment. It supports asset prices while starving the real economy of funding. The illusion of strength persists, even as internal liquidity deteriorates. Financial news often misreads this stage. Commentators focus on resilience, on markets holding up despite tightening. They frame stability as proof that liquidity concerns are overstated. This is backward reasoning. Stability at this stage is a warning sign. It indicates that risk has not yet been repriced, even though the conditions supporting it have changed. Liquidity is also psychological. When participants believe they can exit positions easily, they are willing to hold risk. When that belief erodes, behavior changes rapidly. The market does not need actual illiquidity to react. It needs perceived illiquidity. Once participants question their ability to transact at fair prices, they preemptively reduce exposure. This is why liquidity-driven downturns accelerate so quickly. The decision to sell is made before the need to sell becomes obvious. Risk managers act before losses appear. Funds rebalance before redemptions arrive. The act of preparation becomes the catalyst. Importantly, liquidity withdrawal does not discriminate. It affects strong and weak assets alike. Correlations rise because everything depends on the same funding conditions. Assets that appeared uncorrelated during expansion suddenly move together. Diversification fails not because assets changed, but because liquidity became the dominant factor. At this stage, the system is highly sensitive. It can still function normally under calm conditions, but it cannot absorb shocks. Any unexpected event forces repricing because there is no buffer left. This is the quiet danger of late cycle liquidity dynamics. The market still looks orderly, charts still look stable, but the foundation has thinned. Liquidity is no longer a cushion, it is a constraint. And once liquidity becomes a constraint, time stops working in the system's favor. This is only the first half of the liquidity story. It explains how support disappears without drama. The second half explains what happens when that absence is finally tested, and why the resulting adjustment is rarely controlled. The second half of the liquidity story begins when absence turns into force. At this point, liquidity does not merely thin the market, it starts to dictate outcomes. What was once a background condition becomes the dominant driver of price behavior, overriding fundamentals, narratives, and even policy signals. The first moment of stress rarely looks dramatic. It often begins with a failed auction, a weak demand signal in a government bond sale, a sudden widening in funding spreads, or an unexplained gap in an otherwise liquid market. These events are dismissed as technical or temporary. Commentators search for reasons. Markets move on. But professionals recognize these moments for what they are, tests that did not clear cleanly. When liquidity is abundant, markets absorb poor data easily. When liquidity is scarce, even neutral information can trigger disproportionate reactions. This asymmetry defines the transition phase. Prices begin to respond more to positioning than to fundamentals. The question is no longer whether an asset is cheap or expensive, but whether there is enough balance sheet capacity to hold it. At this stage, leverage becomes dangerous in a new way. Earlier in the cycle, leverage amplified returns. Now, it amplifies forced behavior. Margin requirements rise as volatility increases. Risk models recalibrate, reducing allowable exposure. Funds that relied on stable correlations find those correlations breaking down. Positions that made sense in isolation become untenable in aggregate. This is how liquidity stress spreads across markets without a single headline event. One institution reduces exposure to meet internal limits. Another follows to avoid being last. Selling pressure emerges not from fear, but from obligation. This is why liquidity-driven downturns feel mechanical. They are not emotional reactions. They are balance sheet responses. Derivative markets accelerate this process. Options hedging requires dynamic adjustments. As prices move, hedges must be rebalanced. These flows can overwhelm thin markets, pushing prices further than fundamentals justify. Volatility feeds on itself. The very instruments designed to manage risk become channels through which risk propagates. Repo and short-term funding markets reflect this stress early. Haircuts increase. Acceptable collateral narrows. Rollovers become less certain. Institutions hoard liquidity, not because they expect catastrophe, but because uncertainty rises. Hoarding reduces circulation. Reduced circulation increases fragility. A self-reinforcing loop forms. Equity markets respond late, but sharply. For a time, stocks remain supported by optimism and buyback programs. But buybacks depend on cash flow and credit access. As liquidity tightens, these supports weaken. When equity selling finally begins, it does so into a market with diminished depth. Price declines accelerate, not because sellers multiply, but because buyers disappear. Bond markets offer no refuge. When sovereign issuance remains heavy and private refinancing demand rises, yields stay elevated. Duration becomes risky. Traditional safe havens lose their protective function. Portfolio construction assumptions fail. Investors discover that diversification relied on liquidity conditions that no longer exist. Central banks attempt to manage expectations, but expectations alone cannot create liquidity. Forward guidance loses potency when balance sheet constraints dominate behavior. Even well-signaled policy shifts fail to stabilize markets if participants doubt their effectiveness. Credibility becomes conditional. At this point, policy faces a dilemma. Injecting liquidity aggressively risks reigniting inflation and undermining currency stability. Withholding liquidity risks financial instability. Neither option restores the previous equilibrium. The system has moved beyond fine-tuning. It requires adjustment. Global spillovers intensify the situation. Stress in one major market transmits rapidly through funding channels. Currency volatility rises as capital seeks safety. Hedging costs increase, reducing cross-border investment. Emerging markets face sudden stops. Developed markets experience feedback through financial institutions and trade linkages. This is where liquidity absence transforms into liquidity shock. Not because central banks suddenly withdraw support, but because private participants no longer provide it. Markets discover that the true providers of liquidity were not institutions with mandates, but risk takers with confidence. Once confidence erodes, mandates alone are insufficient. Psychology shifts decisively at this stage. Investors stop asking when markets will recover and start asking how deep adjustment must go. Time horizons shorten. Liquidity preference rises. Cash becomes an asset rather than a placeholder. This shift is powerful because it is rational. Preserving optionality becomes more valuable than seeking return. Importantly, this phase does not require economic collapse. It requires recognition that liquidity is finite and conditional. Once that recognition spreads, behavior changes permanently. Even if conditions stabilize temporarily, the willingness to re-leverage does not return quickly. The memory of constraint lingers. Markets often describe this moment as a loss of confidence. That description is incomplete. What is lost is not confidence, but the assumption of continuous liquidity. Once that assumption breaks, markets must reprice assets to levels that can clear without leverage-dependent buyers. This repricing is rarely orderly. It happens through gaps, volatility spikes, and correlation breakdowns. Policymakers can slow it, but not reverse it. Liquidity can be provided, but trust cannot be forced. Participants must believe that liquidity will persist under stress, not just under calm conditions. The final irony of liquidity-driven downturns is that they are invisible until they are unavoidable. By the time liquidity becomes a headline issue, markets have already adjusted violently. Those who waited for confirmation find that confirmation arrives too late. With liquidity gone and leverage constrained, the system enters its most vulnerable state. It is still functioning, but without buffers. Any additional stress now determines direction, not magnitude. This is the environment in which markets stop drifting and start falling. The next and final chapter explains why timing matters now, why the window is measured in months rather than years, and why the system's remaining flexibility is far more limited than it appears. What remains now is time, and time is no longer abundant. In late cycle environments, markets do not fail because of one dramatic mistake. They fail because the window for adjustment closes quietly. The final phase before a broad repricing is defined not by collapse, but by narrowing options. Every actor still believes they have room to maneuver, but that room is shrinking with each passing quarter. The critical insight of this chapter is simple and uncomfortable. The market does not collapse when conditions are worst. It collapses when flexibility disappears. That is why the window between mid-2026 and late 2027 matters. Not because it is a prophecy, but because it is the point at which accumulated pressures converge with exhausted buffers. By this stage, monetary policy has already done its work. Rates have been restrictive long enough to affect refinancing, investment, and consumption. Fiscal policy has already absorbed private sector weakness through deficits and borrowing. Liquidity has already thinned. Debt has already rolled forward at higher cost. None of these forces are hypothetical. They are already in motion. The only variable left is timing. Markets still function because participants believe relief will arrive before constraints bind fully. Investors expect rate cuts to restore liquidity. Corporations expect demand to stabilize before margins collapse. Governments expect growth to resume before debt service overwhelms budgets. These expectations are not irrational. They are based on historical patterns. The problem is that history assumes capacity. This cycle has less of it. Rate cuts, when they arrive, will not operate in a vacuum. They will arrive into an economy with elevated leverage, weakened balance sheets, and reduced risk appetite. Lowering rates helps at the margin, but it does not reverse refinancing that already occurred. It does not restore liquidity that exited permanently. It does not rebuild confidence instantly. Policy works with lag in both directions. This is why timing becomes asymmetric. Delays hurt more than they help. Each quarter of continued tight conditions forces additional adjustments that cannot be undone. Companies lock in defensive strategies. Households change consumption habits. Investors shorten horizons. Once these behaviors change, reversing them requires more than marginal improvement. It requires conviction. Conviction is scarce in late cycle environments. Global factors compress the window further. Major economies face similar constraints simultaneously. There is no external engine to pull growth forward. Trade cannot compensate when demand softens everywhere. Capital cannot rotate easily when yields and risks converge. Synchronization increases fragility because diversification fails exactly when it is most needed. Geopolitical risk adds another layer of uncertainty. Supply chains remain vulnerable. Energy markets remain sensitive. Strategic competition increases volatility. None of these factors need to explode to matter. They only need to persist. Persistent uncertainty raises risk premiums and suppresses investment. This compounds existing financial pressure. Financial markets begin to reflect this narrowing window through behavior rather than price initially. Volatility regimes shift. Rallies become shorter, sell-offs become sharper. Correlations rise. Defensive positioning increases even as indices hover near highs. These are not contradictions. They are signals that confidence is conditional. At this stage, the market becomes reflexive. Expectations influence outcomes more directly. If participants believe adjustment is inevitable, they act in ways that accelerate it. Cash hoarding increases, credit availability tightens further, liquidity preference dominates. The system moves from drift to direction. Importantly, this transition does not require bad news. It requires realization. The realization that time no longer smooths problems, that waiting carries cost, that postponing decisions worsens outcomes. Once this realization spreads, behavior changes rapidly. The window matters because it is the last period in which adjustment can occur with some degree of order. Earlier action allows losses to be distributed over time. Later action concentrates them. Markets prefer gradual repricing. Systems prefer step functions. When gradual adjustment fails, step functions follow. This is why the period ahead is measured in months, not years. Balance sheets do not wait indefinitely. Debt maturities are fixed. Liquidity conditions are path dependent. Policy credibility is finite. When these elements align, momentum shifts decisively. The final misconception to address is the idea that markets collapse because people panic. Panic is a symptom, not a cause. Markets collapse because structures fail, because leverage meets constraint, because liquidity meets absence, because time runs out. What lies ahead is not guaranteed disaster, it is forced repricing. Assets that relied on perpetual liquidity must find levels supported by real cash flows. Business models dependent on cheap capital must adjust or disappear. Fiscal assumptions must confront arithmetic. None of this happens overnight, but once it begins, it does not stop easily. The window still exists. That is the crucial point. The system has not yet reached the stage where outcomes are fixed. But the margin for error is thin. Decisions made now matter far more than decisions made earlier in the cycle. Waiting for confirmation is no longer prudent. Confirmation arrives only after repricing. This chapter is not a call for fear. It is a call for clarity. The conditions for a major adjustment are already in place. The timing is not exact, but the sequence is clear. When markets finally accept that flexibility is gone, the adjustment will not ask for permission. The crash, if it comes, will not be sudden to those who understand this process. It will feel inevitable, and inevitability, once recognized, moves faster than any headline ever could. The biggest mistake investors make before every crash is waiting for confirmation. By the time confirmation arrives, prices have already moved, liquidity has already vanished, and choices have already narrowed. This cycle will not end because of fear. It will end because mathematics takes control. If you understand how delay works, how debt traps form, how liquidity disappears, and why timing matters, you are already ahead of the crowd. The window is still open, but it is closing, and the market will not warn you when it finally does.